Greetings, and welcome back to the Rose Bros podcast. Today we are joined by Craig Fuller, CEO and founder of FreightWaves, the largest provider of proprietary high-frequency data and market intelligence to the global supply chain industry. Think Bloomberg for finance, but applied to supply chain businesses. Data on the movement of goods across the world, including air, ocean, rail, and trucking, allows customers to understand the state of physical goods in the economy and manage their business operations more effectively. FreightWaves provides supply chain data on about 85% of the physical goods in the global economy, from Iowa to China, which in turn represents about 40% of the total world economy and trillions of dollars in value. As a result, this data is able to provide a good bellwether on the state of the global economy. Prior to founding FreightWaves, Craig was the founder and CEO of TransCard, a fleet payment processor that was sold to US Bank. We sat down for a smooth cup of Rose Bros coffee and discussed how FreightWaves helps supply chain businesses make decisions, the current oversupply of goods in the market and the resulting bullwhip effect, why North American supply chains are vulnerable, how supply chain is a good bellwether for the economy, and why it's pointing to dark clouds now. Enjoy. Also, this podcast is sponsored by headracingcanada.com. Looking for high-performance ski gear this winter? In partnership with four-time Olympian Manny Osborne-Parody, headracingcanada.com is offering the lowest prices possible through its online storefront by passing brick-and-mortar savings on to customers. Check out headracingcanada.com for more info and get your high-performance ski gear for the upcoming season. Well, we'll just do audio then, and we can jump right into it. Craig Fuller, thank you very much for doing this today.
Yeah, Trevor, great to be here.
To introduce you for the listener, you are the CEO of FreightWaves?
Yep, that's correct.
For anyone that is listening, what is FreightWaves?
So FreightWaves is the largest provider of high-frequency data and market intelligence to the global supply chain. So think of FreightWaves the way people think of Bloomberg, but FreightWaves, where Bloomberg focuses on the financial economy and what's happening around finance and economics and tradable positions, FreightWaves focuses on the physical goods part of the economy. So this is the movement of goods anywhere in the globe. So we're tracking products that are moving across the globe, across all modes, which is air, ocean, rail, truck, water, just trying to understand what the state of the physical goods market is and provide high frequency data sets to companies that are either buying or selling physical goods in the economy and giving them intelligence about what's happening.
Where does the data come from? Is it a public source of information, or do you guys have your own proprietary system set up to track that?
No, it's all predominantly proprietary. So we don't take public data. We take highly proprietary and typically exclusive data sets that we get from large software vendors in the space, large platform vendors in the space. So these are software companies that host software that run supply chains. So these are transportation booking systems, warehouse booking systems, and management services, as well as individual companies that are in the space. We collect data on them. But we see about 85% of the physical goods part of the economy, regardless of whether goods are in China and moving to North America or on a truck in Des Moines, Iowa. Chances are that we are tracking that and understanding what's moving across the globe.
To help give perspective on the value of those goods and how much that makes up, are we talking billions of dollars, trillions of dollars?
Well, it's in terms of goods, in terms of the economy, it's about 40% of the global economy is tied to logistics dependent industries. So if you think of what that means, it's effectively, for businesses, whether we're talking a big box retailer or a company like Amazon or a manufacturer, is that they are, without logistics and transportation, their business would cease to exist. It simply would not exist. Civilization would basically grind to a halt and end, because everything that whether we're talking even the grid or the internet or physical goods that you consume in terms of food, agriculture, or just products that you buy, things like furniture and TVs, those are all part of the global supply chain. And that information is really important in terms of tracking it. So if you think about the size of what we're talking about, the logistics industry, in terms of servicing the market, is about a $10 trillion industry global. But if you take the part of the economy that is exposed to logistics, it's about $50 trillion. So when we look at data sets we see a large portion of the overall physical economy at any moment in the day within 24 hours. And so it means that we're looking at hundreds of billions of dollars in goods per day that are transferred through the economy. And the data sets that we have actually track more of the economy than even Visa and MasterCard's networks do, simply because transportation is moving such a high proportion of freight. And not everything that people buy and consume is necessarily purchased by credit cards. But transportation as a mode is actually important to move goods through the economy. And that's effectively what we are tracking.
If you were to explain it to the layman listener, maybe your grandma, you supply the data to the customer to help them make better decisions. If that was your 10-second elevator pitch, maybe?
Yeah, decisions including benchmarking. I want to know how I'm performing versus my competitors. I want to know how I'm performing versus the overall market. Analytics, which is analyzing what is happening in the economy, in the physical goods economy, monitoring events that may disrupt my business or potentially could disrupt it. So we track everything from geopolitical events to things like viruses and ships that get stuck in canals and all the foreign stuff. We're constantly monitoring signals from around the world, looking for anything that could disrupt the flow of goods. And then forecasting what's happening tomorrow or likely to happen tomorrow all the way to the next year. And so our job is to basically monitor all of these activities and events that happen around the globe, basically keep an eye on all the goods movement anywhere in the world at any moment in time.
How'd you get into the shipping and supply chain industry? I believe you were the CEO of TransCard before this business, which you sold.
Yeah, it's a payments business. So TransCard is a payments business. But I grew up in trucking. So my dad started what's now the 5th largest trucking company in the United States. My uncle started what's the 8th largest trucking company in the United States. So I've been around trucking my whole life. I did a payments business that was predominantly involved in fleet cards. So this is fuel that trucking companies use, and sold it to US Bank. And then after a couple of years of sort of working in that business, but not really happy with sort of my outcome, I ended up sort of doing some consulting with a lot of the new ventures that were starting up around logistics and supply chain. Ended up realizing that a lot of the new upstarts were not really doing anything unique, except applying maybe slightly better technology and slight business model innovation. But functionally, the physical goods economy, freight, is all about warehouses and trucks. And so they weren't adding physical assets to the economy, and really realized that there was an opportunity to create effectively the Bloomberg of the global physical goods economy. And that's what I set out to do.
Through your exposure to the supply chain industry and shipping and trucking and all that, you have a hands-on view, a kind of a nuts and bolts view of the economy. How are you seeing rising interest rates impact the physical economy nowadays?
It's not good. I mean, none of what we're seeing right now in the economy is a positive thing. So I think, frankly, Wall Street has got it wrong in the recent weeks by rallying. We're seeing big rallies, but they're rallying into weakness. If you look at the fundamentals in the goods part of the economy, we have slowing sort of retail sales, we have slowing car sales, we have slowing housing market. So there's really nothing bullish except for energy and ag. So commodities, think of it as oil and nat gas. And the only reason those things are relatively bullish is because our biggest competitor globally in terms of goods, in terms of commodities, is Russia and Ukraine. And those are offline. That's why the United States is doing exceptionally well when it comes to the energy markets and agricultural markets, simply because you've taken off so much supply globally. But if you look at the broader part of the economy, housing, auto, retail, those are really, really soft right now, and they continue to soften. So it's not just a matter of rising interest rates. It's a matter that consumers have been, a lot of their spending's been eroded through inflation, and they pull back. And a lot of the retailers have added so much inventory over the past, 8 months, or actually over the past, say, 12 to 16 months, that they simply don't have enough demand to burn down that inventory. And because they aren't selling what they currently have in warehouses, they've stopped ordering new product and to sort of add to that. And so we're seeing a pretty significant slowdown in the physical goods part of the economy. And we've been on this story really since March. We've talked about the fact that there's been a slowdown in retail and the broader part of the goods economy since March. And that's playing out right now.
on one hand, like you said, there's been a shift back to kind of a traditional industry like energy. People with the rising interest rates are coming back to more value-oriented businesses, but it sounds like you're not seeing that in the shipping industry and the trucking segments of the market.
No, we're seeing what we'd call a freight recession. So freight recession is basically a situation that you have declining volume, declining rate, and any significant detraction in volume and rate happen, which is what the freight market has been experiencing since the summer. We have been tracking it since March. We published an article on March 31st that talked about a freight recession was imminent, why we believed a freight recession was imminent. That was 2 weeks before Target and Walmart came out and said they had too much inventory. We saw it in the data because we see the economy way upstream to really what most folks experience. And we saw it in the data. And then in the summer, we saw really interesting sort of developments in China. When China had its first major significant lockdown that took place in April or May of this year, everyone expected once Shanghai and Shenzhen and Guangzhou sort of reopened, there was going to be this surge of containers come across the globe. Didn't happen. We saw about a 40% drop of container flows out of China. And we put out a warning in mid-June, on June 6th, that there was going to be inbound container imports into the United States were dropping off a cliff, and turned out to be correct. It was a contrarian point of view that really took place in June when we had it. And it didn't start showing up in the port data until August and September of this year. And we know from where we've seen the ports is that both LA and Long Beach are down double digits, dropping. The Port of Los Angeles's imports are down to 2009 levels, Great Recession levels, and that's largely consumer driven. So that's telling us that the consumer is really, really, really slow, and there's no incentive for retailers to restock their warehouses.
Usually, after a supply flood, there's an oversupply, and it sounds like kind of basic supply and demand. That's what's happening nowadays, where the markets are flooded with too much inventory.
That's right. So bullwhip effect is the term that a supply chain executive would use, is basically because you had this substantial exaggerated demand that took place in the early parts of the COVID economy, and because it takes a while for those products to be effectively redistributed. If you remember back in April, May, June of 2020, effectively we had shut off the lights of the global economy and shut it all down. And it just takes a while for everything to come back online. It's nothing's coming online instantly because of all these interdependencies and dependencies that are along the supply chain. It's not going to all come up at once. And because of that, we're back at a point now where things are flowing sort of in normal patterns. The bottlenecks are largely gone. But in that, we have a lot of excess that's been built up over the last 2 years. It still isn't burned off. And until we see that inventory burned off, it's going to be really sluggish for anything that's in goods producing or distribution. Is going to take a while to sort of burn through all that inventory.
As somebody who works in supply chain and the shipping industry, or people in retail have been involved for years, it may have been easy to see that coming. How do people like yourself profit off that information, and how do you position yourselves to run your business so that you can take advantage of these situations?
Well, I sell data, so I don't benefit so I don't win nor lose in the direction of the market, the economy. That is from a business standpoint. Certainly when our customers are struggling in a slowing economy, that is going to impact our business, but it's not directly correlated in terms of we somehow trade the market. We don't take positions. We're actually banned trading of anything that's in the transportation, the freight market and logistics market, because we have too much information about what's happening around the goods part of the economy that we don't want any suggestions of improprietariness going on there. So we are not in the business of trading the market itself. But I think what I would suggest is that if the data turns out to be correct, that the U.S. goods part of the economy is slowing, then that is ultimately going to impact every part of the economy, because it is such an important part of, particularly consumer consumption is such an important part of the economy, that the slowdown that we're seeing suggests that there is a broader slowdown. And a lot of the government data that the Federal Reserve looks at, as well as a lot of what hedge funds look at, a lot of this stuff has significant lags to it. The supply chain is very complicated and so many different layers to it. And so you often won't see it show up. There'll be early signs that things are slowing, but it won't actually happen. The slowdown won't happen for quarters upon quarters. And so what we're seeing now just suggests that, a lot of the rallies that we've seen over the past couple of months, whether we're talking the summer rally or the one that we had back in October, is probably premature. If the data, if what's happening in the freight market is suggesting that the broader U.S. economy is slowing down, then you could argue that a lot of those rallies were premature.
Do these cycles, to put it as an analogy, a big ship, if the ship was turning one way in terms of recession right now, how long do these cycles take to turn it? Or in other words, to turn the ship around? Is it years or?
No, freight markets are far more volatile than the broader economy. So you can have, if you go back and look at the freight recessions, we've had the last recession that the U.S. economy had before sort of COVID was you had to go all the way back to 2009. But sort of the Great Recession, and we sort of benefited from an accommodating Federal Reserve, benefited from sort of just expansion that took place from 2009 on. The freight market had recessions almost every 3 years. So we saw a slowdown in 2012. We saw one in 2015. We saw one in 2019. We saw like 3 mini cycles just in 2020. And now we're seeing this. So you certainly are seeing a slowdown. And slowdowns in freight can happen much more violently than what you see through the broader economy. The difference now is that this doesn't appear to be just industrial or just housing or just auto or just retail. It's really pretty wide span. It's hitting all aspects of the economy. And so it does suggest that the U.S. economy in particular is going to end up having a much bigger downturn than I think what a lot of people want or had expected or even talking about at this point in time.
These are really complex systems. Someone might say it's very hard to read these sort of things and it's impossible to tell what's truly going on. Someone might also say that kind of talking your own book in this supply chain and shipping and whatnot in terms of predicting the direction of the economy. But how accurate do you think supply chain is in predicting the direction of the economy? Does it extend to all areas of the country and you can get a good read of what's going on?
Well, I would say the data tells us what we should do. Like it's not I don't have a bias to say, and again, my own book is my own data, right? So, or the data we track. So like I said, we're not trading. I mean, as a consumer who has exposure to equities and has my own money and worry about the market and, so forth. I don't want a slowing economy, and I certainly don't want a slowing stock market. That is not favorable. I don't take big short positions in the market, and certainly don't trade it. And so I don't have a desire to see things fall down. But I will say this: if you look back, and this is all public record because we have 50 full-time journalists that report this stuff, and then I write some myself. Mm-hmm. Back in April 2020, we reported about an aggressive V-shaped recovery in the economy. We were sort of April 15th. We were incredibly bullish about the fact that the economy was going to come roaring back. This was at the height of the COVID lockdowns. This is when massive amounts of layoffs and everybody was really, really worried about sort of the state of the economy. We were sort of one of the first people that came out incredibly bullish. In fact, Bloomberg called me the most bullish guy that they had on TV all month because I was incredibly bullish about where things were happening. That turned out to be true. And the reason we had an advanced look at it is supply chain activity happens so early. You can actually isolate early activity in the economy because if I'm manufacturing something, I need raw material inputs to come into my warehouses. So I'm going to order those goods. And we started to see that activity move in mid-April. If I'm redistributing product through wholesalers to retailers, there's that middle mile that you move product from those warehouses to those retail locations. And then there's the endpoint of the consumer sort of pulling on all that. Well, we saw all that happening back in mid-April, and that gave us a view that the recovery was going to be, April 2020, the recovery was going to be really, really strong. Fast forward to this year, we were on March 31st when we put out a freight recession was imminent. It was a contrarian take, and it turned out to be true. If you look at all the fundamentals of the freight market, look at what's happened in inventories. It was 2 weeks before. It was, again, a contrarian take. And then what we saw in mid-June was a slowdown in ocean import data that actually no one really domestically saw the slowdown until mid-August. And so we've always been 3 to 4 months ahead. And so history will either prove or disprove whether our analysis is correct. I would say the data is telling us that there is a slowdown happening and has been telling us really since March. We've seen companies like FedEx talk about a recession is imminent. Mm-hmm. This is just another data point. Was on June 29th, FedEx held its investor meeting for talking about the forecast for the next year, new CEO, and they were incredibly bullish about the economy and the global economy. That was 3 weeks after we talked about a massive slowdown happening in the market. They didn't see it until really August, when they sort of woke up and said, wait, things are slowing. Mm-hmm. So and this is, another freight broker, C.H. Robinson, is laid off. Amazon's announced layoff today. So we're seeing a lot of slowdowns happen. And so I would argue that it's not necessarily a book. I don't have a perspective on, I'm not making money because the market's bullish or less bullish. We make money because we make accurate calls. Mm-hmm. And people trust our data, and history and time will either prove or disprove that out.
Supply chain is a good indicator of where things are perhaps in the economy.
It is, because people don't order. Here's the thing you have to remember versus, say, the stock market or all these sort of fundamental indicators that people look in the stock market is. There's a lot of noise in those data sets. Mm-hmm. But we're looking at physical goods movement, the volume of goods to the economy, not, the amount of miles people move. People don't move product unless there's demand. Mm-hmm. So they're not going to spend money to shift something or transport it unless there's somebody on the other end that's going to consume it or has ordered it. And so the signals you get in the supply chain data are actually incredibly clean if your focus is around the physical goods part of the economy. And the reason it's clean is that, again, people don't move stuff simply to move it. Now, it's not going to necessarily match up to all of the broad economic data because there's so much noise in those data sets.
Exactly.
It's not going to match up to, so much of GDP is tied to non-goods part of the economy. Things like financial services, healthcare, and government spending drive GDP data. But it actually tells you what's happening in the part of the economy that most Americans are somewhat exposed to, which is the goods part of the economy. That's what it actually tells us.
If you're to put your finger on rising interest rates versus oversupply during COVID versus inflation, is there one aspect that's really weighing on the economy, or is it all three combined?
Yeah, I mean, they're all impacting it, right? And so it's hard to put it on one, but they all work together. So we have mm-hmm. excess inventory. So that's one drag on sort of replenishment. You didn't mention the shift from goods to services spending, which also impacted a lot of retailers. And so when you think about the fact that what happened in March was we had a war that sort of created significant inflation in fuel and oil and mm-hmm. energy prices and agriculture prices. Mm-hmm. So that drove sort of the second level of inflation. All of a sudden, the retailers found themselves with massive levels of overstock from excess ordering. So they have a slowdown in consumer and a shift in consumer spending happening at the same time because the COVID economy was effectively over with and people resumed it. Well, that slowed down further the consumption. And inflation or interest rates have an impact on all of this stuff, but they take oftentimes months or quarters to sort of really slow the economy. What we're seeing, we're only starting to see the impacts of high interest rates now. So it started in March, and it really wasn't until we got really into late summer before housing sort of fell apart. And autos didn't really fall apart until October. Auto consumption and orders, both in new and used, have been fairly robust up until October. Mm-hmm. And it appears that that's now taken, we've seen that slow down. So interest rate increases are a very slow feedback mechanism in the economy, and it takes a while for that stuff to hit. Inventory builds have been building really since August of last year, so that takes some time. But those short-term fuel prices and inflation that sort of happened in that March and April and May timeframe, and consumer confidence sort of being sapped at the same time, is really what slowed down a lot of the consumption.
Do you guys get access to debt levels and the consumer debt levels in your business?
No, we don't. Again, our role is to we look at the same stuff that people do from consumer debt. The FRED, which is sort of the information platform that the Federal Reserve uses, offered by the St. Louis Fed, is a really good barometer to debt levels. And we know that consumer debt levels are at record highs and things like that. But we're not looking at that per se. Again, our focus of the world is entirely based on freight markets, which means the movement of goods from point A to point B. And that's the slice of the world that we care about. And we often will see developments happen in freight and then go ask why. And so that's where these sort of secondary data sets become really important, is if you're seeing a slowdown or an increase in freight demand, then the question is what's driving the sort of out of pattern developments. And that's what we would want to understand, is what's driving that. But we would use other data for that. But the stuff that we live and die on is freight market data. And that freight market data is something that we're drawing conclusions on what's happening in the physical goods economy. And then we ask ourselves why.
You've seen supply chains all throughout the world. You've got a pretty good understanding of the markets and you get a bird's eye view of everything. The critic would say that in the era of globalization, we've made ourselves fragile. In other words, when one supply chain goes down in Asia, for instance, it really makes us vulnerable in North America. What's your take on that? And how do you think we get around that, making our supply chain so fragile?
Yeah, so reshoring and nearshoring are real. So there's been a lot of conversation about it over the past decade, sort of deglobalization. I think Donald Trump made us all aware, and everybody aware, that China was a rival. I think a lot of the sort of geopolitical folks that studied geopolitical trends certainly recognized it. Maybe the folks that are in the State Department or Department of Defense sort of recognized that China was a rival. But I think most mainstream Americans didn't. They thought that China was a docile sort of country that was just going to continue to flood our economy full of cheap goods. Mm-hmm. I think that really changed. I mean, Trump really shocked a lot of people because he was sort of verbose about it and almost just uncouth about how much he hated China. And we're all like, whoa, what is up with this? They're our major trading partner. It wasn't until the COVID economy sort of took over and really over the past 12 months that we realized in the West how vulnerable we are mm-hmm. to these supply chain disruptions. And I think the other sort of reality of it is we've now entered a world that is unique to the past 40 years, where globalization and the fact that other countries would simply pursue economic wealth and well-being for their citizens by participating in this sort of one global market were sort of proven to be somewhat fantastical. When Putin attacked Ukraine, was willing to basically burn down all of its global trading connections, currency access, and et cetera. We sort of realized all of a sudden that, wait, this world is a bit more fragile than we had all forgotten about that. We lived in this sort of fantastical world historically. And then we realized that China, not only its COVID zero policy, was also willing to tear up the book of global trade and not worried about being a dependable trading partner. We realized all of a sudden the world's different. And because of that, I think if you're running a supply chain and you're sourcing your products either directly or indirectly, you have either indirect or direct exposure to China, I think you have to ask yourself, what happens if mm-hmm. China goes to war with Taiwan and attacks it? Can I truly depend on the access to those goods to flow through the economy? And I think the answer is a clear no, that if there is a disruption, then the geopolitical developments will become very hostile to global trade. And in that situation, I'm wanting, if I'm a decision maker responsible for making these decisions, I'm wanting to find alternative sources. And there was a lot of other reasons, a lot of backdrop. The cost of producing goods in China has grown exponentially over the last 2 decades. It's now more expensive on a per hour basis to produce products in China than it is in Mexico. So there's a lot of reasons why this stuff would happen regardless of geopolitical bent. It's just that now these sort of geopolitical stories of, the premier locking it, basically who knows what has happened to the former premier of China. Yeah. But all of a sudden we have a situation where their government feels a lot of very autocratic. a lot of decisions. The fact that they will lock their own people down for months at a time feels very, very autocratic. It just demonstrates that their commitments to their own ideals and ideology is going to outweigh their economic benefits. And I think for that, I think anyone who's running a supply chain has to sort of question, do I really want that to happen? So we're seeing that happen now. We're seeing reshoring come back to the United States. We're seeing manufacturing start to come back to the United States. And long term, it's incredibly bullish for the U.S. economy as we once again get to play the center of the global economy, where it felt like 5 years ago we were losing that to places like China.
In your opinion, is this a change that needs to happen overnight, bringing things back to Mexico?
It won't happen overnight. It's going to take a decade. Like, to remove a supply chain from one country to another is not an overnight experiment. You can't do that. That's why it's so risky. Mm-hmm. It doesn't matter how much money you have. Take a company like Apple. Apple has been working on leaving China or high exposure to China for at least 8 months. So we were told back in, it would have been first quarter, that Apple's intentions are to remove any of the US bound products from China. And it's only recently that we've seen those announcements sort of play out. Vietnam started to play a role in this. Malaysia's playing a role in this. India's playing a role in this. And it's going to take them many, many years to basically decouple large portions of the supply chain away from China and have built that infrastructure somewhere else so that they can have much more resiliency. And this is a company that has more cash on the balance sheet than any other company in the world. And it's going to take them a while to sort of move all of that over. And so these things aren't done quickly. Think about it from the perspective of I need talent, I need people, I need human expertise that understands these products and how to build them. Well, they also have suppliers, and I need a supplier network that I can get those products sourced, my raw materials. Because no company, unless you're in like minerals or mining, is actually the original input point. And they're dependent upon things like cranes and excavators and stuff. So this stuff's all interconnected. So no company's really at the front point of a supply chain. They're all interdependent. And so I wanted to move stuff to a different country. I also have to make sure I have the talent and human capital to do that. I also have to make sure my suppliers are also located in parts of the world where they're near my production point, or at least accessible to my production point. And if I have that, then it's much easier to move it. None of that stuff moves quickly.
Mm-hmm. Fuel expenses are a big part of the supply chain industry. On one hand, the Canadian US federal policy is kind of asking for more production these days, asking for prices to come down. But on the other hand, they're preventing more drilling from occurring. How do you view energy policy with its relation to supply chain? Are you worried about it? Does it keep you up? What do you think in terms of energy costs?
It's the worst part of, say, Western policy is our approach to energy. And it's true in the United States, it's true in Canada, it's true in Europe, is that there's this real view that supporting, I think in any democracy, supporting fossil fuel exploration development is somehow basically surrendering ourselves to a lot of the sort of extreme folks on the extreme end of, there is no climate change. There doesn't seem to be a happy medium between folks that believe in climate change scientifically and folks that think it's a fallacy and it's false. There is no happy medium. And the politicians have said, I don't want to be viewed wrong in history on this. And the noise around climate change is so significant, particularly younger generations are so concerned about it, that I don't want to be wrong on it. So the popular thing to do is sort of surrender our energy policy to more progressive sort of thing. The problem with that is that ultimately hydrocarbons are the most efficient way to distribute energy of any other source. And I'm talking from I view myself as an environmentalist. I put massive amounts of solar. I'm sort of off the grid and stuff as much as I can be. But I also am very rational about the view that we have to have energy. And energy is life. I'm also very rational about the fact that energy production in North America is far more efficient and far more, at least operates with a degree of sustainability and environmental responsibility,
ethical,
than alternative countries and alternative parts of the world. Iran and Iraq don't really care about the long-term impacts of climate change. They're just trying to feed their people. And they're not going to care about drilling for oil where it may wreck an environment and wreck the climate. Whereas at least in the United States, Canada, even in Europe, there is investment made to at least have some environmental standard, some emission standard. And I think the problem is that we have elected people who are somewhat economically illiterate, and I'm talking on both sides of the aisle. I don't care who you're talking about, that have sort of surrendered our environmental desires or surrendered really proper energy policy to these sort of environmental desires. And the best use case of that is natural gas is a far cleaner fuel than, say, diesel. And we could make that conversion from diesel to nat gas in a matter of a decade. We could actually move the vast majority of diesel molecules into the nat gas infrastructure if the amount of money that's gone into, say, truly we'll call it clean energy, solar and wind, et cetera, was put into that conversion. And that would do more for the environment than anything else. The problem is that will never satisfy the true climate sort of extremists, because they view that as sacrosanct to make an investment in hydrocarbons. They want to completely drop what we do today and move into clean energy without any regard for the fact that life can only sustain through having access to energy.
Energy is directly correlated to the quality of life in the modern Western world.
It absolutely is. It is life, right? Energy equals life. I mean, that's the reality. And it's not even the Western world, it's the world. And you see places like Germany that are now turning up coal plants. I mean, coal is not clean. That was a really bad sort of statement by the Republicans where they're like, oh, clean coal. And that was to sort of satisfy the coal mining regions of the country. But it's lunacy to say we are not going to invest in nat gas, but we're willing to turn up our coal plants. And we're not willing to, Germany's turning off its nuke plants and then turning up coal. And it's like,
it's crazy.
I get that it's political expedient to sort of make these long-term deals and policies that sort of are trying to reduce carbon emissions. But the reality is that we have to be realistic that life cannot sustain without energy. And we don't have enough of the clean stuff, quote unquote clean stuff, to be able to provide the global economy. And the clean stuff isn't truly available when we need it most. The problem is that when the wind doesn't blow 24/7, you have periods of time when the wind blows a lot. It's also not distributed. Solar, the sun doesn't shine 24/7. You have seasons. And oftentimes it's those extremes, particularly in the winter when you need a lot of heat where the sun isn't shining. And so there's a lot of just fallacy in this whole energy policy. I would say it's probably of all the policies that our government, at least in the United States, has gotten wrong under the current administration is its approach and understanding of energy policy. It's a disaster. And I would say that you should give the Biden administration some credit for its geopolitical sort of stance on sort of keeping, at least supporting sort of a coalition of countries. Because I hate to think of what would have happened if we sort of all just rolled over to Russia. Like, I don't know what that would have been like. But on energy, they're completely wrong and off.
Like you, I'm a big skier and I enjoy the outdoors. And what's sad is that the opaque green environmental policies have actually ended up backfiring, getting the opposite result of what you want, aka more coal production.
Yeah, because you can't starve your people or freeze them. And that's the problem. I think so much is missed in how much of agriculture and food production is driven by hydrocarbons and how much of transportation is driven by hydrocarbons. And unless we are willing to be cavemen and starve billions of people, and I'm not talking, like, if you shut off hydrocarbons, the world would come to a screeching halt and likely 90% of population would cease to exist. I don't know about you or me. I mean, could I go hunt? Maybe, but like, what would that be? Like, how would I cook? This is the whole thing, is people sort of take this stuff for granted.
Well, I'm sure you're aware of Bloomberg, but shout out to those guys. They've had some great posts on where stuff comes from, and they've really took some nuanced views on the whole energy stuff. So, yeah,
Bloomberg does a great job of talking up energy. So I like Bloomberg's content because I think it has a very sane sort of approach to energy, much of like what we've talked about. And so I agree there.
From high level, things are looking a bit gloomy for the next maybe year or so. I don't know what your time frame might be, but someone with a ton of supply chain data, you see all the inputs and whatnot. Are you viewing things in terms of maybe a year or two, or how would you, for the listener, how would you advise it?
Yeah, I think at the downturn, I think the stock market will recover before the freight market does. And it usually does in terms of we will see the market bottom in the stock market because equity prices will have come down. There'll be a rating of a lot of the companies, and the market will end up much more bullish, much more bearish than it is today. And I think when that happens, there's an opportunity for equities to run. But I will say that as it looks at in terms of supply chain, I think this is going to be a Labor Day. We're going to see softness through at least Labor Day. And you think about the stuff that drives the freight market and drives the figures of good economy. It's retail and consumer consumption. Well, that appears to be slowing. It's the housing market, both direct and indirect housing activity. So it's everything from lumber to carpets to furniture. Whenever somebody moves to a house, whether it's a new house or it's a new to them house, they're buying furniture, they're buying appliances. Those things create a lot of freight demand, and they create a lot of economic demand. Well, with housing market, particularly with interest rates as high as they are, we're not going to see a lot of activity of people moving or buying even second homes. And so that's going to really put a cap on the amount of economic activity that comes from housing. And then auto is also a big driver of freight, and it's a big driver of the economy. That doesn't appear to be bullish either. So we're seeing really three major drivers of freight are going to be really soft. Energy is going to be strong, ag is going to be strong. But beyond those, there isn't an enormous amount of bullishness on my part.
On a side note, you're also the CEO of Flying Magazine. Do you get much exposure to the travel industry and the things that are going on in that regard?
So Flying is all about the pilot, predominantly focused on general aviation. So general aviation is everything from someone that flies a Cessna, a small Cessna, call it the middle class version of private travel, all the way up to the corporate jets. And so flying,
net jets.
I'm a pilot. I just love airplanes. I'm just fascinated by everything that has wings and an engine. And so our focus at Flying is focused on the general aviation sector, which is much larger in terms of aircraft than the airline sector is. The general aviation sector is still bullish about the economy, predominantly because it's a much smaller sector, and there's been a big backlog of orders that have been placed due to COVID and continue to be placed. So it's a market that may withstand a lot of the downward pressure in the economy, but it's also highly discretionary. So there's an argument to be made that if we get into a significant downturn, that a lot of the fundamentals of the aviation sector will dry up as well. We're certainly not seeing that right now.
Well, that's a great conversation. I really appreciate your time, and you explained to the listener kind of what's going on in global supply chain and a bit about your flying experience and entrepreneurial activities. I guess if you leave advice for any entrepreneurs out there kind of navigating the waters, what would you tell them?
I think the most important thing is cash is king in this environment. So you want to be as conservative as possible. I'm making the same decisions in my business. Is a lot of the sort of benefit that has happened over the past 2 years that every business was doing well. I think you have to come into this part of the economy and just be very cautious. And it's happened so suddenly that the change in the market has happened so suddenly that it's still hard to get your head around how bad it could get or how slow things could get. But there is very little light at the end of the tunnel short term. Long term, things will turn around, and you want to be there you want to survive that downturn long enough to get to the point where you can see the upswing. Become
anti-fragile, as Nassim Taleb would say. Thrive when things are bad.
Yep, that's exactly right. So
get your money off your cryptocurrency exchange.
That you should have done 2 weeks ago, right? But if you're still in a cryptocurrency exchange, you should probably do that.
Yeah, just do that right now.
Oh, what a disaster. What a disaster. Well, Trevor, enjoy the time.
Thanks a lot. I really appreciate your time. Thanks for listening, everyone. Hopefully you enjoyed the episode. If you liked what you heard, check out roadsbros.ca, where we will have upcoming shows. Until next time, happy coffee drinking.